Welcome to This Month in Payroll. I'm Rowan Geddes, the Australian lead for PwC's payroll consulting practice. The vision of our practice is to raise the profile and potential of payroll in Australia. And as part of that, we have created this monthly update, which is designed to keep payroll professionals in Australia informed about key events that are happening in payroll each month. On this month's podcast, we will talk about 4 events happening, which is Single Touch Payroll, Superannuation Guarantee Amnesty, the new European Privacy Rules GDPR, and changes to the Victorian Long Service Leave legislation. But let's start with Single Touch Payroll. What better time to start a payroll discussion in June 2018, days away from the kickoff of Single Touch Payroll. STP is clearly top of mind with everyone working in payroll as we approach this 1 July go-live date. If your payroll covers 20 or more employees, at this stage you will fit into one of 3 groups. Either you and your payroll software provider are ready to go, or your payroll software provider has gained a deferral so that they have the right time to prepare, or your organisation has applied for a deferral as a standalone to gain more time to prepare for STP. By now, your payroll software provider should have let you know 2 key things. First of all, whether they do have an extension past 1 July 2018, and if so, to what date. Vendors will have extensions ranging from 30 September through to 31 March. If your software vendor has an extension, it is important to realise that the vendor may still be ready to go live earlier, and if so, the ATO's extension only applies up until that date. It is also important to note that the ATO's penalty amnesty for late filing of the STP reporting forms only applies until 30 June. Therefore, the amnesty period under STP will be shorter for those employers who go live later in the year. If you as an employer think that you'll need more time to get STP ready, past that which your software provider needs, then you can apply for your own deferral through the ATO. You'll need to explain your reasons as to why, and acceptable reasons include a change in your payroll software, a significant change of personnel in your payroll department, or your business is in the process of a merger or an acquisition. Depending on the size of your business, you may need to set out an implementation plan that shows how you will become STP ready by the date to which you're requesting the extension. While there are no guarantees that the ATO will grant the extension, they have been willing to work with employers to ensure this transition to STP is as smooth as it can be. So if you're concerned that despite your best intentions and planning, you can't or may not be ready, we would encourage you to apply for a deferral with the ATO. Secondly, your payroll provider should have advised you whether they will be SBR2 compliant by 1 July 2018. I'll explain SBR2 in layman's terms. So right now, a payroll system needs to be able to transmit data to the ATO. They do this using the Standard Business Reporting or SBR portal. However, under STP, data and messaging needs to be able to flow into the ATO and out from the ATO. SBR2 is the method used to transfer this STP reporting data to the ATO and back from the ATO to the employer. Your payroll provider will either provide SBR2 capability as part of their existing engagement with you, offer SBR2 support as an additional service, or not offer SBR2 support, requiring the clients to select a separate gateway provider for the transmission of the reports. Should your provider not offer SBR2 support, you've got alternatives. Many super funds are linking the SBR2 exchange service to their SuperStream offering. These are large, well-funded systems, which is a plus. They are also used as a tool to drive customers into their super funds as a default fund, which may be a negative. Alternatively, there are standalone exchange services which aren't linked to an on-sell opportunity, but may require more due diligence around controls and support. In addition to your payroll vendor, there are things that you can do as an employer to ensure a smooth transition. Firstly, ensure that your data is correct. It's always a good time to review your wage codes and make sure they're correct, but there's never been a better time than now. STP is about data. The information that is sent to the ATO will be the basis on which they will form a view on your organisation. We are best prepared if we ensure that the data that is sent through to the tax office is clean and accurate. This applies to wage codes, this applies to employee master data. Secondly, check with your IT department that there won't be any firewall restrictions invoked as a result of the need to initiate two-way STP reporting between your organisation and the ATO. While this should be managed by the software provider and won't be an issue if you're outsourcing your payroll, of course, The last thing employers need is to have their IT department raise concerns a few weeks or even days about how STP will interact with their system. Thirdly, consider what employee communications you need to do. There's been a view that STP is a simple change that will be managed by payroll vendors in the background, and that the only thing employees will need to know is that they will no longer receive a payment summary in July 2019. However, examples of data that the ATO could be analysing include TFNs, dates of birth, and addresses. If employees are using PO boxes or company addresses as their residential address, it happens, this will quickly be identified by the ATO. Similarly, if your employee population or your processes aren't diligent about getting employee tax file numbers within the first 28 days, this is a practice that will need to change quickly because it is going to become easily evident to the ATO if employers are not withholding PAYG tax at the top marginal tax rate for employees who haven't provided the TFN in a timely manner. So there's just two examples where long-standing practices may need to be changed given STP. And these changes will require employee engagement. So you need to consider what your employee communication strategy is going to be. We're a few days out from STP, but there's still some areas that need to be ironed out. For example, detail around how STP works with expatriates is still being clarified by the ATO. Also, how errors will be communicated to employers is yet to be clearly explained. This is as much of a journey for the tax office as it is for employers. It's important to recognise that there will be a tsunami of data coming the way of the tax office, which they then need to process and analyse. Employers need to be ready for an increase in queries raised by the tax office as they seek to better understand the data they're receiving and resolve data mismatches. And if the ATO is asking questions of payroll data, then professionals should expect that tax and management may well start to ask questions too. Let's move on to the second update, superannuation guarantee amnesty. In May, the government introduced new legislation that will provide a one-off 12-month amnesty to encourage employers to voluntarily disclose historical superannuation guarantee non-compliance. Normally, when an employer underpays SG for its employees, an SG charge arises. This means that penalties can be imposed by the tax office, there is an administration charge of $20 per quarter, and the payment of the SG, now an SG charge, is non-deductible for income tax purposes. Under the amnesty, employers that take advantage of this will receive the following concessions: the removal of the administrative penalty of the SG charge, the ability to claim a tax deduction for the payment of the underpaid SG, a full reduction of any penalties that may otherwise apply in relation to the historical SG non-compliance, the ability to make the payments directly into the employee's super funds, rather than channeling these through the Australian Tax Office. Superannuation has been a hot topic ever since Industry Super Australia released their report almost 2 years ago, saying that 1/3 of employees weren't receiving the right amount of superannuation, and also claiming that the ATO wasn't being proactive enough in chasing these underpayments. The response was quick. There's an increase in resources provided to the ATO's Superannuation Compliance Task Force that's targeting non-compliance, and there's been a pendulum shift in how willing the ATO was to work with employers who identified and self-corrected SG underpayments. For much of this year, employers have been met with an inflexibility from the tax office that's resulted in large penalties from SG errors and no ability for discretion. For this reason, the proposed SG amnesty is welcomed. It will encourage employers to review their records and confirm that they are compliant for SG purposes, knowing that if they aren't, then as long as they compensate the employees, they won't have to pay a penalty to the tax office. In addition, the super they pay will still be tax deductible, and they won't have to pay the admin charge. Now, $20 per quarter doesn't sound like a lot, but if an employer discovers an SG underpayment that affects their workforce of, say, 250 employees over the last 5 years, for example, through an error in the coding of an allowance, the administration charge alone would be $100,000. So it makes a difference. Importantly too, it's no coincidence that the amnesty period aligns with the introduction of several other measures focused on improving SG compliance, including the introduction of single-touch payroll and also increased director penalties for non-compliance. But the carrot of the amnesty comes with the stick at the end as well. Employers who choose not to voluntarily disclose any shortfalls within the amnesty period and who are subsequently found to not have met their obligations will not be granted these concessions in the future. This means that once the amnesty is completed, if the ATO discovers SG underpayments, then on top of repaying the SG plus interest, on top of the non-deductibility and the administration charge, the ATO will also impose penalties. These penalties range from 50% of the outstanding SG up to 200%. So why do SG errors occur? In our experience, the most common reasons that inadvertent SG non-compliance occurs are errors when setting up or adjusting pay codes. So to protect against this, employers should take steps to immediately initiate a superannuation code review, ideally focused on the payroll system mapping, the superannuation processes, and controls around the payroll functions insofar as they relate to superannuation. The SG amnesty is going to run through until May 2019, so there's a time sensitivity to this. This is the time to ensure that the SG that we have calculated and prepared is correct. The third topic to talk about is data privacy, and this one's driven by Europe. In May 2018, the General Data Protection Regulation, or GDPR for short, came into force in Europe. These rules are more prescriptive than the privacy laws in Australia, and they apply to any business or public sector entity that holds, controls, or processes personal data of EU residents, regardless of the business's location. This means that any Australian company that holds personal information of EU resident employees will be captured. Unlike Australia, there is no exemption for a private sector employer handling employee personal information. There is no payroll exemption. So many Australian businesses may therefore be unknowingly required to ensure that their data handling practices comply with the new GDPR requirements. So what does this mean? Well, there's a few key changes, being 1. Consent. There's a presumption that an employee's consent is not freely given to an employer because there is an imbalance of power between the employer and the employee. Accordingly, an assessment needs to be undertaken by the employer to ensure that when they collect personal information, there is a lawful basis for processing that information. Secondly, a transparent collection of privacy notices. So the GDPR imposes a stricter requirement of disclosure to employees before collection of data. This applies to payroll. It also applies to customers. So you might have noticed an upturn in emails from your online shopping provider asking you to confirm that you are okay with the collection of data. That's GDPR. The new privacy notices must include the categories of personal data collected, the intended purposes for processing the data, the legal basis for processing the data, the recipients of the data, the retention period of the data, and they need to outline the employee's rights to request, access to, correct, and delete their personal data. The key point to this is that where an employer currently asks an employee to complete a privacy declaration under Australian laws as part of their onboarding process, the words in that declaration are probably insufficient and need to be updated. If employers do not currently require a privacy declaration to be completed as part of the onboarding process, well, that's a further conversation, isn't it? The third change under GDPR is employee rights. So employees will now have the rights to access, correct, erase and restrict the processing of their personal data. They will also have the rights to transport the data with them to a new employer. This will require payroll functions to consider how easy an individual's employee data is to identify, transact upon and move. This may require an update of the processes. The final change is that there is an increased protection around the collection of sensitive personal data. So certain categories of information, such as religion, biometric data, trade union membership, they're all subject to more stringent protections, and employers will be prohibited from processing such data unless it falls within an exception, such as collection for legal purposes. So again, consideration needs to be given to the reasons as to why we're collecting this data. What are some of the actions that employers can take to address these new GDPR requirements? Well, first up, businesses should take an initial assessment to determine the scope of the impact of GDPR on their payroll processes. Is your business affected? And if so, does your payroll process data which is not strictly necessary for the performance of the payroll role? Is any of the data being collected non-essential data? If your business is affected by GDPR, it may be that simply by putting in new policies or new processes, we can ensure that the required consents are gathered as part of the normal onboarding and annual review process. Secondly, measures may need to be created to monitor and detect data breaches. Mind you, given the challenges facing many Australian businesses at the moment, given data breaches in the recruitment field, reviewing your data protection policies is something that all businesses should be doing, regardless of GDPR. Also, along the lines of data security, a question to be considered is whether the payroll function's data security processes meet the information security requirements of the GDPR. For example, there are set timeframes within which personal information must be destroyed and data breaches notified. A new action that payrolls need to be taking is to map out the employee data flow, as it may be held on various systems, from recruitment systems to HR systems to corporate registers to third-party payroll systems. Mapping this data flow is important when it comes to allowing employees to monitor, transact and move their payroll data. Finally, where data is transacted outside of the EU, such as processing payrolls in Australia, there are specific rules to follow around the GDPR data transfer mechanisms for cross-border transfers of data. The fourth update to discuss is long service leave. Long service leave has always been a tricky area to deal with. It's generally dealt with by workarounds and Excel spreadsheets rather than through payroll systems. It just got harder. Changes have been made in Victoria, effective 1 November 2018, to long service leave. These changes will affect all employers in Victoria around the periods during which long service leave accrues, when long service leave can be taken, and how long service leave is calculated where an employee's hours of work change. Specifically, long service leave will now accrue during all paid parental leave and during the first 52 weeks of unpaid parental leave. Secondly, in Victoria, an employee can now take parental leave for up to 104 weeks before creating a break in service. This is up from 52 weeks under the old rules, so a lot more employees will retain their long service leave entitlements. Employees will now be able to take long service leave after 7 years of continuous employment. That's down from 10 years. Employees will also be able to take their long service leave 1 day at a time rather than over a maximum of 3 periods. So payrolls will now need to track long service leave taken as well as accrued 1 day at a time. Finally, where an employee's hours of work change during their employment, long service leave used to be calculated at the highest average over the previous 12 months or 5 years. Now there's a third calculation required. Now long service leave also can be calculated at the highest average over the employee's entire period of employment. So what does all this mean? First of all, the opportunity for long service leave is now increased, both in the number of employees covered and also the amount of long service leave payable. Secondly, the administration around tracking unused long service leave will increase. And thirdly, there will be a transition period where some employees will be covered under the old rules and other employees will be covered under the new rules. Those Excel spreadsheets are going to get a new round of workout. Finally, I'd like to wrap up by congratulating the Australian winners and finalists at this year's Global Payroll Awards held in Lisbon in early June. Australia has always represented itself well above its weight, and this year was no different, as there were 3 Australians represented. Congratulations to KeyPay, who won Payroll Supplier of the Year. Congratulations also to Michelle Whitmore of PwC, who was a finalist for Payroll Student of the Year, undertaking her payroll qualifications with Australian Payroll Association. And congratulations to Tracy Angwin, CEO of Australian Payroll Association, who was a finalist for Payroll Consultant of the Year. This has been Rowan Geddes. I hope you've enjoyed this month in payroll. I will have new payroll updates next month and every month, but in the meantime, if you have any payroll questions, you can find information on our website, pwc.com.au/payroll, or you can email me at rowan.geddes@pwc.com. That's Rowan with an H, mind you. Or you can message me via LinkedIn. Thank you, and I'll talk to you next month.